Welcome back to Old Men, New Money. I'm Davoudi, and this is the final episode of Module 4 on Real World Asset Tokenization. We've covered real estate that isn't working yet, treasuries that are working beautifully, and public equity that's starting to happen. Today we're tackling the category that might matter most, private equity tokenization. This is personal for me. I've been an angel investor in over 15 companies and owned businesses across multiple verticals like aviation, hospitality, healthcare, technology, and financial services. I understand private markets from both sides, both as an investor trying to access the deals as well as an entrepreneur trying to raise capital for my own deals. And I'm going to tell you something that might surprise you. Private equity tokenization has the best chance of genuinely transforming markets, but it's also the hardest to execute. Let me explain why and what needs to happen for it to work. Why private markets matter. Before we talk about tokenization, let me give you context on why private equity matters so much. The private markets are massive. Private companies, private equity funds, venture capital, private credit. We're talking about over $10 trillion in value globally. Some estimates go even higher. But here's the thing. Most investors can't access private markets. You need to be an accredited investor in the U.S., which means earning over $200,000 per year or having over $1 million in net worth, excluding your primary residence. Even if you meet that threshold, you need connections to get you into high-quality deals. The minimum checks are high. Most private equity funds require minimum investments of $250,000 to $5 million. Venture capital funds are similar or higher. Direct investments in private companies often require even more. And then you're locked in. 5 years, 7 years, 10 years, no liquidity until an exit. If the company gets acquired or goes public, you get paid. If it doesn't, you're stuck in the mud. This creates massive inequality in wealth building. The wealthiest investors access private markets where companies stay longer before going public and where returns have historically been higher. Average investors are stuck in public markets with lower returns. If tokenization can democratize access to private markets, reduce minimums, and create liquidity, that's genuinely transformative. That changes who can build wealth and how capital flows to growing companies. And that's why I care about this more than tokenized treasuries or tokenized public equity. The potential impact is far bigger. Let me break down the three main approaches to tokenizing private equity. Model 1, tokenizing fund shares. Traditional private equity funds raise capital from limited partners, deploy that capital into portfolio companies, and return capital plus profits when they exit the investments. What if you tokenize the LP interests? Investors buy tokens representing fund shares instead of traditional partnership interests. This provides some liquidity through secondary token trading while the fund is still active. It lowers minimums so more investors can access institutional quality funds. And it simplifies administration because blockchain handles cap table management and distributions automatically. Model 2, tokenizing direct investments in private companies. Instead of raising venture capital through traditional means, a company issues security tokens directly to investors. Those tokens represent equity in the company with voting rights and profit participation. Investors can trade tokens on secondary markets even though the company is still private. This gives companies access to more diverse capital sources. It gives investors earlier liquidity than waiting for IPO or an acquisition, and it enables fractional ownership so investors can diversify across more companies. Model 3, tokenizing secondary markets for private equity. Creating platforms where existing private equity stakes, whether in funds or in companies, can be bought and sold as tokens. This is purely about improving liquidity for existing private equity investors. Each model has different value propositions and different challenges, so let me walk us through them. Tokenizing private equity funds. Let's start with tokenizing fund shares because I think it's the most promising approach near term. Traditional private equity fund economics look like this. The fund raises committed capital from limited partners. Those LPs are locked in for the fund's lifetime. The fund makes investments over 3 to 5 years, holds them for another 3 to 7 years, and returns capital as investments exit. If an LP needs liquidity before the fund ends, they have to sell their stake in a complicated secondary transaction. These transactions are expensive, time-consuming, and often happen at discounts to net asset value because liquidity is so poor. Now imagine tokenizing those LP interests. Each LP receives tokens representing their fund share. Those tokens can trade at alternative trading systems or other platforms. An LP who needs liquidity can sell tokens with complex legal paperwork. The fund's economics don't change. The general partner still manages investments and receives carried interest, but LPs gain optionality. The challenges are governance and regulatory compliance. If tokens can trade freely, how do you maintain accredited investor restrictions? How do you handle know your customer requirements as tokens change hands? How do you manage voting and consent rights if there are thousands of small token holders instead of a dozen large LPs? Those are solvable problems through smart contracts with embedded compliance, but they require careful legal structuring. Several platforms are working on this. Republic, Securitize, and others have tokenized fund structures. The volumes are still small, but they are growing. Then there's the direct tokenization of private companies. Now let's talk about companies issuing security tokens directly instead of raising traditional equity. I've looked at this for some of my own companies. The pitch is compelling. Lower costs than traditional fundraising, access to a global investor base, built-in cap table management, automated distributions, and potential for secondary liquidity. But here's where it gets complicated. Most private companies aren't ready for this. If you're a seed stage startup raising your first $500,000, tokenization adds complexity you don't need. You're better off with a simple, safer convertible note from angel investors. If you're a growth stage company raising a Series B, your lead investors are venture capital firms that want traditional preferred stock with liquidation preferences, board seats, and pro rata rights. They're not set up to buy tokens. So you'd have to maintain parallel structures or you'd lose access to that capital. Where direct tokenization makes sense is for companies that don't fit traditional venture capital models. Profitable businesses that want to raise growth capital without giving up control. International companies that want to access U.S. investor capital. I've seen a few examples at work. Revenue-generating software companies that tokenized capital instead of taking on debt. Niche manufacturing businesses that wanted patient capital from customers and users. These are not unicorn startups. They're real businesses that benefit from alternative capital sources. But this is still niche. The volume of private company capital raises through tokenization is tiny compared to traditional venture capital and private equity. The third model, secondary markets for existing private equity stakes, might be the biggest opportunity. There are trillions of dollars locked up in existing private equity investments. LPs who want liquidity but can't exit easily. Employees at late-stage startups sitting on vested stock options worth millions on paper but unable to sell and needing liquidity. Creating tokenized secondary markets can unlock this liquidity. Platforms where you can list your private equity fund stake or your startup equity as tokens and find buyers. The challenge is valuation and information asymmetry. Public stocks trade on transparent information. Everyone sees the same quarterly reports, the same SEC filings, but private equity is opaque. How do you price a stake in a fund when you don't know all the portfolio companies or their performance? How do you price startup equity when valuations are stale and there's limited disclosure? You need information infrastructure alongside trading infrastructure. That's expensive and complicated, but if you can solve it, the market opportunity is massive. Even a small percentage of private equity trading on tokenized secondary markets would be billions in volume. Companies like Forge, NASDAQ Private Market, and others are building infrastructure for this. The tokenization layer could make it more efficient, but the core challenge is information and valuation, not technology. The regulatory complexity. Let me talk about regulation because it's the biggest barrier to private equity tokenization. In the United States, private equity is typically structured under Regulation D exemptions from SEC registration. Companies can raise capital from accredited investors without full SEC registration. This keeps costs down and speeds up fundraising. But Reg D has transfer restrictions. You generally can't sell securities bought under Reg D for at least 1 year. And when you do sell, the buyer usually needs to be accredited. Tokenization doesn't change these restrictions. If you tokenize a Reg D offering, these tokens are still restricted securities. You can't just trade them on open markets. So how do you create liquidity while maintaining regulatory compliance? The answer is alternative trading systems with built-in accreditation verification. The platform checks investor credentials before allowing them to trade. The smart contracts enforces holding periods programmatically. All trades are reported for regulatory compliance. This works, but it means the secondary market is limited to accredited investors. You haven't democratized access. You've just made it more efficient for wealthy investors to trade private equity. True democratization would require different regulatory frameworks, maybe a new exemption category that allows retail investors to participate in private markets with appropriate protections. Some countries are exploring this. The U.S. is cautious. Until regulations change, private equity tokenization is mostly about improving efficiency for existing investors, not opening access to new ones. My personal experience with private investing. Let me share my thoughts as someone who's been angel investing for years. I love private investing. I get to support entrepreneurs building real businesses. I get to participate in growth that public market investors never. I've had investments that have returned 5 times, 10 times, even more. But I've also had investments that went to zero. I've had companies that took 8 years to exit when I expected 4. I've had situations where I wanted to sell my stake but couldn't find a buyer. Would tokenization have helped? Maybe. If there had been a secondary market where I could have sold stakes in companies I'd lost conviction in, that could have been valuable. If I could have diversified across more companies with smaller checks because tokenization lowered minimums, that would have reduced my risk. But the fundamental nature of private investing wouldn't change. These are illiquid, risky, long-term bets on businesses that might fail. Tokenization can't fix the underlying risk. It can only provide marginal improvements in liquidity and access. That's still valuable, but it's not magical. The success cases that give me hope. Despite the challenges, there are examples that make me optimistic. Spice VC tokenized their fund and raised capital from a much broader base of investors than traditional VC funds reach. They've shown it's operationally viable. INX, the platform Douglas helped build, has demonstrated that tokenized securities can trade with regulatory compliance. Their success with equity crowdfunding laid groundwork for private equity tokenization. Securitize is tokenized interest in real estate funds, venture funds, and other alternative assets. They build infrastructure that handles the compliance and custody challenge. T0, the blockchain subsidiary of Overstock, has created secondary market trading for private securities with proper compliance. These aren't huge volumes yet, but they prove the model can work, and the question is whether it scales. What would cause it to scale? Regulatory clarity, institutional participation, successful exits that demonstrate returns, and killer apps that only work with tokenized structures. We're not there yet, but the foundation is being built. Where this could go in the next decade. Let me paint a picture of what successful private equity tokenization looks like 10 years from now. Companies routinely issue security tokens for their Series A or Series B rounds alongside or instead of traditional equity. The token issuance is just as easy as traditional equity, but provides built-in cap table management and potential for secondary liquidity. Private equity funds issue tokenized LP interests as standard practice. LPs understand they're still locked in for a fund duration, but have access to secondary markets if they happen to need liquidity before the exit. There are deep, liquid secondary markets for private equity tokens with accredited investors trading actively. Employees at late-stage startups can sell vested equity more easily. Early investors in successful companies can take some profits before exit. Information infrastructure exists that provides transparency in private companies and funds. Valuation is still imperfect, but better than today's opacity. Investors can make informed decisions about private equity tokens. Regulations evolved to allow non-credited investors to participate in private equity through tokenized vehicles with appropriate investor protections, maybe a $10,000 cap per investor per year. This democratizes access without creating systemic risk. And we see institutional investors, sovereign wealth funds, pension funds using tokenized private equity alongside traditional private equity because the operational efficiencies are compelling. That's the vision. Is it realistic? Parts of it are. Parts might take longer than a decade or might never happen. But the direction of travel is clear. Onward. Lessons from all 4 episodes. We've completed our journey through real-world asset tokenization, real estate treasuries, public equity, and private equity. So let me synthesize these patterns. The assets that tokenize successfully solve real liquidity or access problems. Treasuries solve the problem of crypto natives wanting safe yield. That's why it worked. Real estate didn't solve a problem existing solutions don't address. That's why it struggled. Regulatory clarity enables growth. Treasuries had clear frameworks. That helped adoption. Private equity has complex regulatory requirements. That slows adoption. Institutional participation legitimizes categories. BlackRock entering treasuries was huge. When major private equity firms started tokenizing, that will accelerate private equity tokenization. Technology alone isn't sufficient. You need legal frameworks, market infrastructure, information systems, and clear value propositions. Blockchain is just one piece. And finally, transformative change takes time. The most optimistic predictions were wrong. Real estate tokenization didn't revolutionize property investment in 3 years. Private equity tokenization won't revolutionize alternative assets in 3 years either. But over 10 years, the changes could be substantial. What should you do as an investor? If you're considering investing in tokenized private equity, here's my guidance. Start with the fundamentals. Is this a good private equity investment ignoring tokenization? Is the fund manager experienced? Is the company addressing a real market? Is the valuation reasonable? If the answer to any of these is no, tokenization doesn't make it a good investment. Understand the liquidity illusion. Just because something is tokenized doesn't mean you can exit easily. Look at actual secondary market trading volumes. Most tokenized private equity has minimal liquidity. Assume you're locked in for years. Evaluate the platform and custody. Who's operating the platform? What's their track record? How are tokens custodied? What happens if the platform fails? These operational questions matter more than the blockchain technology. Read the legal documents carefully. What are your rights as a token holder? How do your distributions work? What happens in bankruptcy? How is governance structured? Private equity legal docs are complex, tokenized or not. Consider the fees. Tokenized private equity often has multiple fee layers: platform fees, management fees, carried interest, transaction fees. Add them up and compare them to traditional private equity costs. And diversify appropriately. Private equity should be a small part of your portfolio unless you're extremely sophisticated and wealthy. Tokenized private equity is even higher risk because it's newer and less proven. For me, I'm selectively participating in tokenized private equity where I see strong underlying fundamentals and reasonable valuations. But I'm not betting heavily on it. Connecting to our next module, we've spent 4 episodes on real world asset tokenization. We've seen what works, what doesn't, and what might work in the future. Douglas has taken over Module 5 to talk about something different but related: the consumer model and consumer engagement through tokenization. This is about using tokenization not just for investment, but for building communities, rewarding customers, and aligning incentives between companies and their stakeholders. It's Douglas's brainchild and his framework that he's been developing and implementing. I'm excited for you to hear him explain it because it represents a different way of thinking about what tokenization enables. We focused on financial markets and investment. Module 5 focuses on engagement and community. Both matter. Both are part of the future of digital securities and tokenization. In the closing thoughts, private equity tokenization has the most potential to transform markets because private markets are so inefficient today. But it also has the most challenges because of regulatory complexity and information asymmetry. As an entrepreneur and angel investor, I want this to work. I want platforms where I can buy and sell private equity stakes more easily. I want diversification across more companies with smaller checks. I want exits before companies go public or get acquired. But I'm realistic about the timeline. This will take years to mature, probably a decade or more before it's mainstream. That doesn't mean you should ignore it. It means you should watch it, experiment cautiously, but don't bet your financial future on it working quickly. The long-term trajectory is clear. Private markets will become more accessible and more liquid. Tokenization is part of that story, though not the only part. Your job as an investor is to participate in the evolution while managing risk appropriately. That's what I'm doing with my own capital. I'm Ali Davoudi. This is Old Men, New Money. If this module on real-world asset tokenization gave you clarity on where the opportunities and challenges are, share it with investors and entrepreneurs trying to navigate the space. Thanks a lot.